Hi, this is Seth Holm. Today I'm going to be talking about an interesting topic for transportation investors. Is 2019 more like 2007 or 2001? The reason I ask is UBS recently put out a report taking a look at how transportation equities perform following the first rate cut in a Fed rate cutting cycle. The last time we had a rate cutting cycle was 2007 and 2001. Turning to 2001, after the first rate cut, turned out to be an amazing buying opportunity for transportation equities. Specifically, trucking stocks a few months after the first cut were up about 55%. Rails were up about 35%. And more importantly, both of these outperformed the S&P 500 by about 50% or more that year. Now turning to 2007 is a little bit of a different story. Not great, but not horrible. A few months after the first rate cut in 2007, rails did pretty well. They were up 3 or 4%. Trucking stocks, not so much. They were down 13%. Not great, but not terrible, at least in the first 6 months after the cut. They did end up going down in 2008 and 2009. Now what this is telling me is because transportation stocks aren't down that much, or they could be up a lot following the first rate cut, that's because that they're leading indicators as stocks. So by the time the Fed is actually cutting interest rates, it's usually because the economy is deteriorating. So these transportation stocks may have already been beaten up. So to wrap things up, UBS concludes Fed rate cuts should be positive for transportation equities valuation support. However, they see that being overridden by fundamentals, which are still deteriorating, as we've seen here in the second quarter earnings reports, where a lot of companies have missed and or guided lower. Anyways, to summarize, it'll be interesting to watch. Here at FreightWaves, we'll be paying attention to this.